say good morning, good afternoon, or good evening, depending on where in the world you're signing in from today. Very, very international audience, going, I believe, from Alaska to Singapore. So thanks, everybody, for joining us for a discussion today on mayhem in securities markets and the price of metals. I'm very eager to get started today, so I'm going to keep intros as short as possible. But I am joined today by Brian London of the Gold Newsletter and New Orleans Investment Conference fame, Rick Van Nieuwenhuizen, the CEO of Contango Ore, Bob Archer, CEO of Pinnacle Silver and Gold, Diane Garrett, CEO of Hycroft Mining, and my very own patron, Daniel Barrington, the CEO of SIX. I'm going to jump right into first questions today. And Brian, I'm going to start with you, because I remember it was your conference last year in November. There were three speakers in a row that were predicting 3,400 gold by April. And they were actually very close, with it currently, at the time of writing my notes, sitting at 34.27 US. Now, this combined with securities markets falling nearly every single day, seems like, many are seeing bears everywhere they look. So what I'm curious is, do you think we'll see a formal recession this year?
Yeah, I think we will. I think that's the great fear, and now it's transitioned into the great expectation at this point, and I think gold's partly reacting to that. You know, we've seen just an incredible move in gold, and I don't think anyone really knows, other than probably literally a few people in the entire world, knows what's going on. And I think it's, broadly speaking, a combination of things. I think the idea of a recession, the uncertainty around tariffs, the issue with the Fed facing about $7 to $9 trillion of treasuries that have to roll over this year, with rates going in the opposite direction from which they hoped and planned and strategized. I think there's a lot of reasons to buy gold, and there are a lot of reasons why people are buying gold. What's interesting about this is that it doesn't appear to be driven by Western speculators or retail investors or really anybody in the West. It seems to be driven from Asian investors, most likely central banks. Most of the price action is during Asian trading hours, and it is of such overwhelming force that it beats back the typical bear attacks in the Western markets on the New York in New York trading. So that points to central banks, and I think that's part of the general sell America theme, where you see treasuries being sold, treasury yields rising, the dollar falling, while gold is going up. So your three traditional safe havens, out of those three, two are not working, and gold seems to be the only option left for anyone looking to preserve their wealth and or be a part of the Sell America trade.
I appreciate that. And I did see China putting in vending machines where you can weigh your gold and it just transfers money directly to your account. I thought that was neat. Saw that this week.
The other thing that happened is not only is Trump declaring a tariff war with China, but I think he's declaring a gold war with China. He tweeted, or I don't know what you do on Truth Social, but post on Truth Social that remember the golden rule, with the gold rules. And the U.S. has over 8,000 tons of gold, and China's got somewhere between 2 and 4. So that's 1/4 or one half. And they're the sixth largest owner of gold in terms of central bank holdings. So has the tariff war turned into a gold war? Interesting.
Yeah, that's an interesting point.
And then also on China, the Chinese ETFs are really performing very strong right now. So we're seeing a lot of retail in the Chinese market coming into gold quite significantly recently.
So if gold wants to double their gold reserves, do they just do what the United States did in the 40s and make it illegal to own gold and capture all that privately held gold?
There's a move there. Bob, I'll get you in here. Do you think recession's incoming? What do you think it means for gold?
I think certainly in Canada, anyways. I think we're likely to head into recession probably sooner than the U.S., but I think the U.S. will likely follow as well, and that's just playing off the gold silver theme a little bit as well. In economic downturns, silver tends to act more like an industrial metal. and often follows copper more than gold. And so it's you've got a couple of themes sort of playing off each other, and on the silver market right now, where it's not acting so much as a monetary metal the way it often does following gold, and it's more or less I wouldn't say flatlining, but it's not rising as quickly, and because of the uncertainty over recessions and economic downturns. So I could see silver staying or rather underperforming compared to gold for a little while, and perhaps until we get out of this fear of recession, and then you can see silver start to move. And once silver does move, it can go very quickly and go off in parabolic, but then it'll come back quickly as well, but often only it'll retrace about 50% to where it started the parabolic move, and then it'll consolidate for a period of time, then do the same thing again. So it tends to trade in a kind of a hockey stick pattern, and I think that's one of the reasons there's a bit of a divergence in gold and silver prices. And the other, just to build on what the other folks are saying, central banks don't buy silver, and if the price of gold is going up largely because of central bank buying, then silver's getting left behind, and it'll take a while for it to catch up. So that's something to keep in mind as well.
No, for sure.
Yeah.
And we will get back to silver today, but Diane, go for it.
Oh, sorry. No, I agree with everything you just said, Bob. And another consideration is that, as gold becomes loftier, I mean, you're right, because silver has that industrial application, and it's known less as a monetary metal than that. But as gold becomes loftier in its prices, and people get priced out of owning gold, then they can tend to go into silver and at least hold that as some kind of a quasi safe haven, although not to the extent that gold is as well.
Certainly. I think one of the really interesting things about this market right now is that a lot of the fundamentals and price action is coming from Asia. And meanwhile, here in American markets, there's a tremendous amount of firepower on the sidelines. If you recall, during the COVID era crisis, money printers printed a tremendous amount of trillions of dollars into existence, and a lot of that money still exists. Similarly, a lot of the funds that raised during COVID still have access to that capital. If you look at portfolios like Warren Buffett's, you can see the amount of cash that's there. Many corporates only have tremendous amounts of cash. And so I think the big question is, if there is a recession, and right now betting markets are putting it at about a 56% likelihood of a US recession right now, which is down about 10% from where it was at the start of April. But if there is a US recession, where does that capital rotate into? And is it sufficient enough to even create a bull market in the context of that recession? If we see buying, for instance, into gold in American markets, that could be really significant on the price action side, especially for assets like silver, gold, platinum, and so forth.
No, appreciate that. And there's one comment that just came into the chat from Nira. What's the framework to think about how high gold price can go? That actually leads really well into my next question, which is, look, I know the top callers for gold have looked very silly over the last years. People have been calling the top for a long time now, but I'm asking you guys to look silly for me here today. And Bob, I'll start with you. Do we think a temporary top is here for gold? Where do we think about the trajectory of this run?
Well, I'm looking at 3,500 as a bit of a psychological barrier here. And, we sort of powered through 33, 3,400. And, this is something that Brian and I have spoken about in the past, where whenever you do get a major psychological barrier for gold, it often can take about 3 runs on average before it actually powers through and stays there. So the fact that, overnight it got to like 34.99 and 70 cents. So within 30 cents of that barrier, and then it backed off, and we're sitting here now about $75 back from that. We could see that same sort of thing again, where it'll try several times before it actually breaks through, and that can take a little while. It can take days, weeks, maybe even a few months. So that's one thing where it might take a little while. So we might get a bit of a temporary correction here. And another thing to consider is that as we head into May here and into the summer, we're getting into a little bit of seasonality, where precious metals tend to dip off during the summer as well. So that's also something to take into consideration. So we might see a little bit of that. So yeah, we could see a little bit of a temporary setback, but over the longer term, I think it'll continue to move higher.
Awesome. Rick, I'll throw it to you next to look silly if you'd like and try to call it top for gold.
Yeah, so just thinking about what I said earlier about this gold war, tariff war, gold war that's developing with China, and who has the gold. The last time that took place in earnest was pre-World War II, and things were gearing up, and the world was in a very unstable place. Tariff wars were going on. So a lot of similarities to that period, and President Roosevelt at the time repriced gold in a very blatant fashion, and that's when the U.S. didn't have $36 trillion of debt. It had billions of dollars of debt, and need to finance. It knew it needed to finance the war, and that was going to cost billions of dollars. Things don't cost billions of dollars today. Things cost trillions of dollars. That's 1,000 times. That's 3 more zeros. Do we add 3 zeros to the gold price? I don't think that's crazy. And now it's not going to happen overnight. I think we talked about recession. I think we're in a period of stagflation. I think we've had a recession going on for a while. If you take out the government jobs that Biden created, so stagflation doesn't fix itself overnight. The Fed can do one of two things. It can improve employment, or it can cut interest rates, but it can't do both at the same time. So this thing plays out over 10 years, just like it did in the 80s. And we don't have stagflation because of an oil prices have gone up. The oil crisis that occurred in the 70s and 80s. We got low oil prices. So we're worried about deflation now. So yeah, we're in a pickle, and this thing plays out over time. And why not have rotation from overvalued tech stocks? Why are they the king of the crop? Maybe it's time for commodities to be the king of the pile. And so things like silver, gold, and copper, people rotate into that, and that's certainly consistent with Trump's theme. So build it in America, and it's taking metals to build stuff. So I don't know. That's kind of what I see playing out over the next 10 years.
Yeah,
Certainly.
Appreciate that. Go for it, Daniel.
Yeah, just to add on to Rick's point, historically, gold has accounted for about 30% of global wealth in terms of the value of all of the gold combined against the value of everything else. Right now, we're in the single-digit percent. And so to your point, I think that right now we're in the anomaly phase where gold historically is worth so little on aggregate. And I think we just start returning back to historical means, which historically have been in that 30 to 50% range. You see much more, much different gold prices than today. And so the 5 figures of price action that you're referencing, Rick, is well within the realm of possibility.
Brian, I'll throw it to you. I know you follow and write on the day-to-day gold price more than most people I know. Do you think we're close to a temporary top? I think that psychological barrier is serious?
Yeah, I think it is. And Bob did a good job of reciting back some of the rules of the game and what we've seen in previous bull markets. And if you apply the rules of technical trading, what we've learned in the past against this, you would have to argue, at least on this move, we're nearer the end than the beginning. But it just seems like the typical rules aren't applying here. When you look at markets getting overextended and overbought, that assumes you're dealing with typical investors who get over enthusiastic, then you run out of new buyers, then the enthusiasm wanes and the buyers vacate and the price plummets, and you go through those stages of emotions in a typical trading environment. But what we're seeing right now is steady, strong, unemotional buying that really does point to central banks, points to Asian central banks, and points to China. And I don't think these are buyers that are going to be exhausted, or this is buying that will be exhausted at any point in time. So it's hard to really gauge this. It really depends on the whim of the Politburo and the People's Bank of China at this point. There's generally a selling America theme that's broader than China, and that we see in the Treasury yields, and we see that in the dollar index. And gold is a part of that trade that I think is broadly global. But a lot of this, I think, points to China. And, Rick mentioned, what is China's level of gold holdings? I think it's closer to 5,000 tons. And literally, I think they are buying now hundreds of tons a month, and secretively. And we don't know where that's going to go. If you look at the longer sweep of history, these big bull markets in gold, of which I count three, the early 70s, the late 70s, and the 2000s, they've typically gone up off the base between 5.6 and 8.2 times, which would lead us to a $7,000, $8,000 gold price at the end of this cycle, whenever that may be. I hope it's 5 years down the road and not 5 months at this rate, but I'm thinking it's more toward 5 years. Now, if you look at the 70s as one monolithic bull market, then you get a gold price that went up over 20x. And that gets you into a new monetary regime with gold as a central part of it, where currencies are the dollars backed by gold, and you're looking at a gold price above $20,000 to $25,000 an ounce. We don't know. We really don't know. I just know that if you bought gold on all of our urgings over the past few years, you're happy right now, and you probably need to own more going into the future. But yeah, I think we're close to the end of this rally, but I don't think we're near the end of this bull market. Again, that's applying the old rules of thumb, which may not apply this time.
Appreciate that. I think I saw this week gold is a better bet than the S&P 500 and Berkshire Hathaway over the last 25 years. So interesting to see. Diane, I'll throw it to you for any last comments on calling a top before I move on to something from the chat.
I think a lot of it, I think it's triggered by a couple of things, and Brian mentioned it, is, there's a lot of the central bank buying clearly that is pushing gold up and keeping it at these levels. And I agree that's going to continue to happen, that buying. But I also think that there's, and how much of a percentage is allocated to the concern over the tariffs. And I do think that the tariffs is something that is going to come to an end, and probably not last through the rest of this year, because I don't think the administration can afford that. I think there's got to be some resolution on it, and parties are at the table. And I think the question then becomes, when that does happen, whatever that looks like, will it put a bit of a damper on gold buying? Because not from the Chinese per se, but because people will feel like, okay, well, that threat is gone now, and we'll see what the ultimate tariff structure turns out to be. But I could see it not continuing at the pace that it's continuing, but at a slower pace going up. So I don't know that I feel like it's at the top yet. I think there's still some more room to go. And, but, I can't argue with anything that Brian has said. And I think that, could we ultimately have a 10x and a 20x, as Brian and Rick are talking about? Sure, that's definitely possible.
No, appreciate that. I got one interesting.
Just keep in mind, and just for, I think, just to put it out there, that doesn't mean that gold companies are infinitely profitable, because that's happening because of inflation. So just. No,
exactly. Yeah. I mean, we're getting a benefit from higher gold prices and then probably lower oil prices too. Right now, we're seeing some benefit there, but inflation overall is still catching up with them because costs are rising at a similar rate.
And that may not slow. Yeah, there's one interesting question from Tate Sullivan in the chat. It's two-part. One, is the price action in gold recently related to what we've seen in foreign currency changes, or is it truly a separate phenomenon? And then a fact-based question, I'm just curious if anybody knows, does China buy its gold in US dollars or in other currencies as well? I'll throw it to anybody who's got an answer on that, actually.
Well, gold is priced in dollars globally, so it really is meaningless. It's just an exchange rate. They'll buy the dollars, buy the gold, and there you go. And whoever ends up with the dollars may go back into their home currency. So I think that's largely irrelevant. I think the relation to the currency moves is because of that selling America theme. I think central banks and I think China are buying gold as part of a greater strategy to sell the dollar and sell or simply not buy treasuries.
I appreciate that. Go for it.
Yeah, look, if you need to take care of $36 trillion of debt, you want a cheaper dollar, and that's consistent with Trump's theme of inviting people to invest in America. It's easier to do that when the dollar is low, not when the dollar is high. So now I think these themes are starting to come together. And again, I think we're not the stagflation thing is going to be stuck here. We're stuck with this for a while. It's not going away anytime soon.
And Rick, I do want to start with you on this next one, because I do think in the last several years we've seen a lot of the speculative money obviously go into tech stocks and cryptocurrency, and within crypto, from the reasonable like Bitcoin to one's called unicorn fart dust and all the crazy stuff that made it to $1 billion in 2 seconds. But I'm curious, when in this bull do you think that money rotates back into commodities?
I think we're starting to see it. I think you're finally starting to see ETF. Investments in ETF, gold ETF specifically, if we just focus it on gold. And that's sort of the start, I'd say. People don't know what specifically to invest in, but they're investing in a pool of gold related investments. So I think I think we are seeing the start of it. You're seeing the S&P go down. You're seeing the tech stocks come off quite a bit. So I think what's happening mostly now is the money sitting on the sideline. I think a number of people have mentioned that. Warren Buffett sitting on billions of dollars. So that money will come into play, and I guess they're trying to figure out what's going to happen with tech. Is this just a plateau, or are we along for the ride? They've pumped the hell out of AI, and I think we all know, I believe that AI is fantastic. It's got a lot of military uses, but I don't know, that Johnny doesn't do his homework anymore because he's got AI to answer all the teachers' questions is really a good thing for a use of AI. So AI is useful for military because if you don't do it, you're screwed, and you gotta keep on top of what's real and what's fake. And but that sounds like government stuff to me. So I think the shine's coming off the tech stocks. I think people are going to recognize that Facebook is just an advertising company, and just should it really be worth as much as it's worth? I don't think so, and so I'd love to see the commodities be the beneficiaries of that, and I think we're starting to see that.
I think so too, because they have been the competing asset classes for our sector for quite a while now. AI, technology, and we're starting to see generalists. They're starting to become more engaged, and that's what we need to really blow up. And there are some that are starting to dip their toe in. So when you have the performance that we've seen in silver and particularly gold, then I think people are rolling out of some of those other asset classes into commodities now.
I think there's a more of a focus now too on mining in general, more than I think I've ever seen in my career. Just from the general public, it's partly because of the whole climate change thing and folks looking at critical minerals and all the things that are required for electric vehicles and all the rest of it, whether you believe it or not. But as we're seeing all these deals now, say with the U.S. and Ukraine, for example, the minerals deal there, governments being more supportive of mining projects in Canada and the U.S. and elsewhere. And it's bringing mining more to the forefront. And you're seeing that in the regular media now, that you never used to see that. And if there was ever any mention of mining in the regular media, it was usually something bad, some disaster somewhere, or how mining's bad for the environment and so on and so on. But that's all starting to shift now, and it's becoming more of a positive narrative. And that's something I don't ever recall seeing before. I think ultimately that will be good, because I don't think most people really understand the mining industry or know how to invest in it. And to Diane's point about the journalists starting to come into this now, and they're looking at it and say, okay, there's all this focus on mining. We need mining. Governments are supporting it, and so on and so on. But where do we go? How do we invest in it? And so I think it's going to take a little bit of time, but I think that focus is there, and I think it's going to continue to increase, which ultimately will be good for the sector.
Yeah, Bob, I think you make a lot of good points, and we do have a U.S. government, U.S. administration now that does proactively support mining. I don't remember the last time we really had that.
Yeah, exactly.
It was.
Yeah.
I wasn't even in the Reagan time period, because that was all about oil. But so we're definitely seeing, and you're seeing it on both sides of the aisle. You're seeing Democrats and Republicans finally connect the dots. We all been connecting the dots a long time ago when you talk about climate change and electrifying the transportation and energy grid. It's like, yeah, you need metals for that. Well, it's taken 20 years literally for the media and the politicians to actually connect the dots, but they are finally connecting the dots.
I'm glad you said that, Rick, because that was the best kept secret, that you could go to all this green energy and electric vehicles, but we're not going to do any more mining, right? So that was the best kept secret, that you actually need these metals. And I think you're exactly right. I mean, that's what this administration is doing, and is connecting the dots between, they're supporting mining because we have to have it, and reducing, some of these burdensome regulations, so that we can have the metals that we can then transition into green energy. So I think people are starting to recognize that.
Yeah, and I think, as part and parcel of that, what we're seeing is kind of a deglobalization effort. It's not just selling America, but countries pulling out and looking inward and making sure that they have the resources. And when we're in this relatively small mining sector, and we really don't appreciate the kinds of money and capital that are out there. I mean, we look at Doge finding $1 billion wasted here and $1 billion wasted there. If the U.S. government, for example, becomes more nationalistic on developing resources, $1 billion will not only buy up every junior company in any particular area play on the globe for copper, gold, or any critical metals, but it will develop the damn projects, and who cares about the economics? It's just going to get done. So there's a lot of money out there. If it gets focused on bringing these resources to market, it's going to happen. And, we're going to be amazed at how quickly it happens, and the kinds of capital that will be deployed, and not very intelligently, which for junior mining people invested in junior mining sector, we don't necessarily want it to be deployed intelligently. We want it to go buy up all of the companies in our individual portfolios, the dogs as well as the good ones. And, and that, if there's one truism, one thing that happens in every cycle, that happens, that money does not get deployed smartly, and that rising tide lifts all boats. I think that's what we're going to see now with the metals prices, at least the gold prices now. It's eventually going to pull Western speculators into the sector, and also perhaps, national governments.
Just one other comment on this U.S.-China thing. We in the West didn't connect the dots, but China did. And China did 20 years ago, at least 20 years ago. So we've got a lot of catching up to do. And I think the Trump administration is the first administration in a long time to recognize that we are actually behind, and we need to catch up. So I think all this is good for commodities, and specifically for gold.
I think one of the drivers over the last 30 years has been investment into bits rather than atoms. And that's why so much money has gone into software companies, in large part because the attraction is that the next marginal unit of product that you sell is essentially at a zero cost base. What we've seen really in the last 10 years or so has been a movement into hardware-based companies, with companies like Tesla or SpaceX or others proving out that physical atoms are actually investable. With data centers out in AI, that becomes even more significant. The thing that fundamentally, in my view, as someone on the technology space and in the mining space, that separates these two markets is how few dedicated resource funds exist in today's market relative to the number of dedicated funds that exist in the technology space. All that really needs to happen for us to see a bull market in the metals and mining space that is profound, where you're looking at 10x or 20x or 50x type valuations, or for dedicated funds in mining to emerge again, to start investing again, to make money again, and for that nascent investment industry to grow the same way that we've seen it grow in the technology industry. And so that's really all that's been missing. And I think that the catalyst that we've been waiting for, which is that the thing we get out of the ground needs to be valuable, i.e. the gold price, the silver price, the palladium price, whatever it may be, that's finally here and will continue to be here. And so I think that for any investors that are watching, really what you should be paying attention to are the emergence of dedicated resource funds and the amount of capital that's coming with that.
Appreciate that, Daniel. There's a lot of people in the chat who are dying for us to focus in on silver for a second. So Bob, I'll throw one to you that's from the chat. I know we've already talked about the silver-gold ratio a bit, but B Church asks, when the Fed does lower rates, he wonders if silver will catch a wave and just jam higher. What do you believe, crystal ball gazing-wise, is the trajectory for silver in the next couple of years?
Well, I mean, the silver price is really driven by investment demand. It's most of the use is in industrial, but the price itself is driven by investment. And so, as I mentioned earlier, right now we have a bit of a tug of war going because people are being uncertain about the economies, and so that's holding the silver price back. But at some point, it is going to want to catch up to gold as more of a monetary metal. And as Diane alluded, silver is kind of like the little sister of gold, and as gold gets maybe too expensive for the average person, they'll start to turn to silver, and so a lot of it's more retail driven, and silver is a much smaller market, and that's one of the reasons why when it does go, it goes very, very quickly, because people pile into it, and it just takes off from there. So I don't know that it's necessarily going to be tied to interest rates. It's difficult to say what the actual catalyst might be to trigger that drive. But when it does go, it will go quickly. And so I think now that we're in this sort of a period of consolidation, this is the time when you want to be buying, you want to be owning silver and getting ready for that rise, because when it does rise, it goes very, very quickly, and that's not the time you want to be chasing it upwards. That's the time when you want to be figuring out, where you exit that particular run. And, if you're lucky enough to catch it at a peak, then that's great. And, then you wait for it to drop back a little bit, and then it'll consolidate again and get ready for the next one. So, this is really the time to be buying silver, I think.
I appreciate that. Anybody else have notes on silver before we jump on? I know lots of people in the chat want to talk about silver for a bit.
Yeah, I'll just mention, that silver is acting more like a base metal in the world today. And usually when the price spike that Bob's referring to happens, that's usually a top in the precious metals space. When that ratio of gold to silver, we're at about 100 here now, and when it goes the other direction and gets down into the 50 territory, that's usually historically has been a top. So it's is it to bring up points that Brian has made several times, do the old rules apply? I don't know. Gold's being used more and more in AI because it's such a dependable electronic connection. If you need things to happen, when you want your airbag deployed in your car, it's a gold connection that makes that happen, not a copper connection, not an aluminum connection, not a silver connection. It's a gold connection. So these metals are definitely becoming more industrial. Gold is not acting like an industrial metal at all right now. Silver still is. Does it become poor man's gold? Does poor man have any money to invest in silver? Do they invest in crypto instead? We didn't have those things before. We didn't have the last time in the 80s when the the silver price went crazy. We didn't have crypto. So I don't know. Is it different now? Don't know. It definitely is different. Is it different enough to make the old rules not apply? I don't know.
I don't know, but it's more complex today. A lot more factors.
Yeah, it's hardly the 80s anymore, for sure, in a lot of ways. I do want to briefly scare the crap out of everybody in the audience and talk about worst case scenarios for the U.S. economy and for the U.S. dollar. I know Rick's already referenced stagflation, a famously impossible quandary from Argentina to the U.S. to try and figure out how to deal with it. There's also the risk of a huge money printing episode. In these kind of worst case scenarios, what do we think gold does then? Do we think it continues its rise? Do we think miners continue to rise, or do we think they drop alongside everybody else? I'll throw it to anybody who's got a hot take there.
Well, I'll take that. I think what we're seeing right now is not so much a prediction of a worst case scenario as a recognition of where we are. I don't know that I would term a money printing episode as a worst case scenario. I think it's what's going to happen. I think it's what has to happen from purely a mathematical standpoint. We have a tremendous debt load after 45 years of ever easier monetary policies and ever greater debt accumulation. And the Fed in particular right now is in a debt trap, and the dollar as the world's global reserve currency must be printed, and in a money printing episode, as you put it, dramatically, it has to be devalued to address those debts. But it's not just a dollar story. It's fiat currencies in general have to be depreciated to handle the debt loads that are existent now around the world. So I think it's going to happen. And that's why I don't think that whatever happens in this particular rally in gold, I don't think it's the end. I think we're looking at the gold prices over the longer term. And I hope it's the longer term that are going to be much, much higher than they are today as this monetary regime gets reordered or reset in some way. And I think that's going to involve gold in some form or fashion.
Yeah, can you spell QE? Which I'm not sure which one we're on, but I mean, the Fed's between a rock and a hard spot. What do they do when they're between a rock and a hard spot? They print money.
And possibly quite a bit of money. Daniel, I'll throw it to you for any doom and gloom you've got about the state of the U.S. economy.
Yeah, certainly. So one of the things that I'm paying quite close attention to is seeing what's happening globally. And I'm a bit surprised to not see so many sovereign debt crises or general currency crisis internationally beyond what we're currently seeing. And so I think whereas in the 2008 recession, what we saw was US fell first, other markets fell second, what I'm anticipating largely is the opposite. I think as other markets try to basically get out of this trap and the situation that the US has basically put the world in, I think we're going to see significant decline there first. And so that's largely what I'm paying attention to.
Appreciate that. Bob, Diana, if you have any additional thoughts, I'll throw it to you guys.
Not really. I don't think I have much to add to what folks have already said on that one.
Yeah, no, fair enough. I do know there's a lot of stackers in the audience today based on the questions that I received in advance. I'm curious, I know we won't get into the specifics of investment advice on the panel today, obviously, but I'm curious, when gold's on a tear like this, what are the pros and cons to buying physical versus securities versus ETFs? It's a question we get a lot at SIX. Anybody who's got a instinctive answer, but Rick, I might throw it to you first, actually.
Well, you should invest in gold producing companies. You get the best leverage there, certainly from just a leverage standpoint. You buy a gold bar; it's nice to look at. I always found it very funny with gold that you spend so much time and effort digging it out of the ground and refining it and polishing it up so it's nice and shiny, and then we stick it back in the ground. It's always struck me as a very interesting business from that perspective. But no, I think we talked about before the rotation. I think the rotation's underway. It goes into ETFs because people don't know what to invest in, but they think they need to be exposed to gold. So I think ETFs fills that role. But ETFs kind of like buying gold, especially the ETFs that are backed by gold. The other ones are a promise to deliver gold, but they're not actually delivering gold. So I would be if you're an investor in an ETF, I'd be very specific about what kind of ETF you're investing into. But I think the gold producers provide you the best leverage.
Appreciate that. Bob, I'll throw it to you there for what are the pros and cons of each piece?
I think it really comes down to an individual investor's risk tolerance, because you're buying bullion. There's really very little risk there, and then you move through ETFs and into securities, and you move along that channel, and as your risk increases somewhat, but then so does the leverage that Rick's talking about, and the reward that goes with that. So it really comes down to an individual's preference as to what you want to achieve with an investment. And there are a lot of people that will say that bullion isn't really an investment because it doesn't pay interest or anything. It's more of an insurance. But you can also use bullion as collateral in order to invest in something else. So there are different ways to look at it. But generally speaking, as you move up that chain from bullion to ETFs to securities, it really comes down to an individual's risk tolerance and what you hope to achieve.
Yeah, completely agree with Bob's comments. Yeah, I'm more a fan of direct investment in equities versus ETFs. I think that's where you get your
likewise.
They require a lot of commitment and a lot of homework and a lot of diligence on the investor's part. But I think that's where you can really gain some of your most significant leverage.
Yeah, you can be a bit more thoughtless, I guess, with ETFs. You got to really do your homework with individual securities if you want to beat the crew. Brian, I'll get you in there. I know you've done a amount of thinking on this. For just talking to investors, what do you think is the right move in a bull market like this?
Yeah, I don't think it's either or. I think it's both. There are two reasons to buy gold and silver. One is as insurance, and that just means you're taking whatever portion of your wealth that you're putting into bullion and you're insuring it, protecting it against something is going to happen. That's going to be the devaluation of your currency, the drop in the purchasing power of your currency. And I think we can all feel pretty confident that that's going to happen to a greater and greater extent over the next few years in virtually any currency out there. So it's insurance. And I tell people to always buy physical metals, get that component of your portfolio set and look at it as insurance and don't look at it as something you want to sell or bet on the price. Now, that said, there is an investment angle to all of this, and that's when you recognize that the macro picture is arguing for higher metals prices vis-a-vis your currency, and you can invest on that trend, on that theme, in a number of ways. The way that we focus on in gold newsletters through the junior mining sector. And the beauty of that sector is that it's extremely inefficient, what Diane just alluded to, that you have to do your homework in that sector. But if you do your homework and you subscribe to the best newsletters out there, go to the conferences, go online to conferences like this and hear about companies and do your homework on them, you can find many instances where the market temporarily leaves behind or creates undervalued companies, and you can take advantage of that. And there's very few sectors out there that can be as rewarding as this, but it can be risky. The risk comes with the reward, except, I might add, in situations like this where we already have half of the equation done. We have record high and rising gold prices, and we have mining companies that are still near long-term lows. Your risk is mitigated greatly in that kind of an environment, and it's very rarely that we see this kind of a situation. I would venture to say, if you combine all of the aspects of the market we're in right now, it is literally unprecedented. And you don't get handed opportunities like this by the market on a silver platter like this, rarely, if at all.
Well said.
Generally, in my view, I can usually think about investment opportunities as one of two categories. Either you make a little bit of money over time, or you make a lot of money all at once. And I think this current market presents you the best of both worlds. And so when you're constructing your portfolio, you want to be segmenting it based on your appetite. And to that end, I think that there's a lot of good options.
Appreciate that. I got some individual questions for you guys now, real quick. Rick, I'll start with you. I know you talked already about how Trump is the first president in a long time to put a actual positive focus on mining, but it's also true in the micro sense of seems to be the first president in a long time to put a positive focus on Alaska as a state, and letting business actually happen in the state. I'm curious what that means for you, and just if you could go over some of the things Trump's done for Alaska or noted for Alaska so far.
Yeah, I mean, certainly Trump's been good for changing the mining sentiment in general, but also, as you say, specific to Alaska. He definitely has a soft spot in his heart for Alaska. I think it was his great-grandfather who was part of the Klondike Gold Rush. So, and he just likes the place. It's obviously a red state, and the state likes him. So, people, he's put directives out specific to Alaska. I think under the Biden administration, we had something like 80 specific executive orders that were negative on developing business in Alaska. So the first thing Trump did was undo a bunch of those. So yeah, it's been very positive. I think you're seeing, one of the things that's been recently one of the executive orders to focus on advancing critical metals quickly through the permitting process. So that's something that we're hoping to see come to realization. We have our Johnson Tract project that is in the permitting process now. So we're hoping to see that move along quickly. I think there's a few other projects in the state that can be at that stage as well. But I think in general, it's a good thing for the country if we're going to tackle the critical metals issues that we have as a country, which is that we're 20 years behind China in this regard. We need to see refining and not just production, because we need to actually produce the metal, not the concentrates that produce the metals, because the Asian market has that captured right now. It's Japan, Korea, China, Indonesia, and India. So if we want more metals produced in this country, we need more refining, and I think you're going to see more talk about that as the politicians connect the dots.
Oh, appreciate that. I think that's really helpful context. Bob, switching topic here. I know you've got a new project in Mexico. I'm curious if you could just share with the investors in the room, how is the Sheinbaum government treating mining? Is it different than the previous government?
Yeah, it's much more positive. Mexico went through a difficult period under AMLO for about 6 years. I mean, it's no secret that he wasn't really a friend of the mining industry, and he's very much a populist president and would sort of pander to his voter base, and there was a lot of rhetoric and talk about banning open pit mining and that sort of thing, which scared a lot of investors away and was frustrating for companies already there with permits in process. But President Sheinbaum is much more pragmatic, I would say. She's a very smart lady. She's surrounded herself with some very smart people in her cabinet, and she's listening. She's listening to what her ministers are saying. She's listening to what industry is saying, and I think all of this business with tariffs and so on, and the potential impact on the economies of Mexico as well as Canada and other countries is going to be a net positive for the mining industry because mining is something that, unless you're full on in construction mode where you're having to import a lot of machinery and steel and so on, that may be impacted to some degree by tariffs. It's, the investment, particularly in the early stages, exploration and development, is something that's not really affected by tariffs at all. But it does bring in a lot of foreign investment, provides jobs, and and benefits to the overall economy. And, so now with economies being hit, I think President Sheinbaum is going to be looking at ways that she can build up the economy and to help offset, where it's being hit elsewhere. And I think it's something like 80% of Mexico's exports go to the U.S. So there will be a major impact on their economy there with the tariffs, however they play out. And so I think there's a renewed focus on mining. But having said all that, because AMLO was sort of a mentor for her, she does belong to the same party. She can't just come straight out and say, "Oh no, we're not going to do that anymore," and throw out everything that he said and say, "Well, we're going to go in the opposite direction." So that's not happen. That's not going to happen either. But I think she will take advantage of this current situation to start gradually shifting the government's view and support of mining in Mexico. And there is no more talk of banning open pits. And in fact, they're starting to permit projects that have been sitting there waiting for a while. So I think we'll start to see more projects getting permitted over the next little while. But it's not going to happen overnight, because one of the things that happened through the AMLO period was that he laid off a lot of people within the government agencies that approved these permits. And so when a company would make an application, it would just sit on somebody's desk for years and nobody would be looking at it. And so now that they're starting to look at these permits again, it's sort of having to dust them off and almost start from scratch. And so that, that's going to take a little bit of time for these things to work through the system. But it is happening. And, we're hearing a lot of positive feedback. So I think overall, it's a positive time for Mexico. And I think it's a great time to be investing there, because I think Mexico will come on strong in the next few years.
Awesome. Appreciate that. Brian, I'm going to throw it to you next. I know this has been a pretty interesting year, and as an avid follower of you on X, I know that to some degree you think it's a unique period in time. But I am curious, just historically, what time periods or parallels can investors look to for any kind of clues to what happens next?
Yeah, great question, Romeo. You look at gold, and despite the fact that it's been money for 4,000 or 5,000 years and is the oldest asset on the face of the planet, it is really one of the youngest investable assets out there, and has only been really an investment since 1971 thereabouts, and really in the U.S. 1975. So actually, I have seen every cycle in the the history of gold as an investable asset. Although I was only a teenager in the 1970s, so I think it's safe to say I was interested in other things at the time. But I've studied the 70s. I've lived through every other cycle that we've been through with gold. And you mentioned it in your preface. I think this one is unique. When you look at the spectrum of characteristics for this market, I don't think we've seen anything like this before. I think at some point it's going to fall back into the kind of situation where we can apply the typical rules of the game, as it were. I think we're starting to see, and what's interesting is, despite the tremendous run in gold so far this year, the mining stocks have broadly leveraged that gain. Gold was up about 15-16% in the first quarter, and mining stocks, as measured by the major indices, were up about double that. So they have, by and large, leveraged this market. And what we're seeing right now is that funds, hedge funds, investors, institutions that looked at the first quarter report card, and either they were in the sector or they were not. And I don't think they can go a second quarter with showing that they're not in this sector. So we're starting to see a lot of money come into metals and miners, but they're looking at gold and thinking, well, we missed that move. How can we play this game? How can we play it, this sector? And you look at the mining stocks again, still near long-term lows by many valuation methods, and they're looking at that as the way to play it. So they're starting to come into the sector, and it's a very small sector. So just a small shift in allocations is and will have a really outsized reaction in the sector. So yeah, it's unique. It's starting to play out according to plan in the mining stocks, at least. And I think that's why this window of opportunity remains open, at least for now, for investors who want to get positioned.
I appreciate that very much. Daniel, I know you're invested in a lot of mining companies and were when a lot of people were in tech stocks. Two kind of questions for you. What do you look for in a mining company to make your bets? And also, where do you do your research?
Certainly. So generally, I look for asymmetrical opportunities. I tend to prefer companies at the earliest stage of life cycle. And I've been fortunate enough to be involved in two of them, where they've gone from millions to billions in market cap. And so really the thing I isolate on is the individuals behind it. I found that more than anything, it's not about grades or ounces in the ground. It's a business about people. And the very best people will figure out a way to make the company successful. Some of my best investments have changed the type of asset that they had. They've changed their jurisdiction. They've changed everything about them except the people. And that's how they're able to go and achieve these disproportionate successes. And so that's where I start. And so to evaluate people, what I look at is obviously their history, their backgrounds. But the most important question I ask myself is, would I leave what I'm doing now to work full-time for them? And if the answer is yes, that's usually a very good sign that it's an investable opportunity. And that's really been the philosophy I've had that's yielded the highest returns for my portfolio.
And where do you do your research, Daniel?
I love platforms, obviously, like Six. I'm a huge fan of CEO.ca, big fan of TradingView, many other platforms. I find that often looking at the company's website, picking up the phone and calling the CEO directly. I think this is one of those undervalued things in this sector, which I truly love about it, which is that if you pick up the phone or if you go to an event like Six, you can submit a question and actually get a response. And so a huge part of my process is through those direct conversations.
Appreciate that. And Dan, I'm going to throw one at you. I know you've managed mining companies through different stages of life. I'm really curious, when do bulls like we're seeing now reach explorers and developers? Because I know there is typically a lag. What do you think the trajectory for those companies is from here?
Okay, great. I'd also like to say, Daniel, I really appreciated all your comments that you just made there. I think you're spot on. When do they do? I know how they do it. They do it slowly, unfortunately, by the time they invest in the producers, because with commodity prices high, I mean, they're going to go to producers because that's where the reality of that higher commodity price is hitting the bottom line in real time. But I completely agree with a couple of comments that were made about, we're in this market now where people sometimes feel like, okay, well, maybe I've missed the gold run. They're going to say the same thing again when it gets to be 3,700 and 4,000 and 4,200. But if they're looking now at a way to get in, and this big disparity between the physical metal and the equities, that is your opportunity to get in. And we are seeing it. We are starting to see that with the performance of some of these developers. So there is a lag. You're absolutely right. I think the last time we've seen lags like this, it was somewhere on the order of 9 or 10 months. We can argue that the disparity between the physical metal and the equities has been in existence for a lot longer than 9 months. But with this recent run up in commodity prices, I think we probably still have a few more months to go. I think the producers are what are consuming those investment dollars, and then it's going to go to the near-term developers that are close to construction, and then the last, of course, is the exploration. But you'll start to see those institutions going down the chain. And I guess it was either Rick or Brian's point, is that this is a very small industry. And when money comes in, particularly from the generalist, it needs to get deployed. And, all boats will rise with the tide. So we could see a convergence of explorers and developers also moving up. But I'd also comment that the producers are now also starting to look around. There was a time when they were looking for just cash flowing assets. Well, those are few and far between, and those that may have been available are not available. I am aware of assets that were put on the market for sale that are now not being put on the market for sale because of these higher commodity environments. So where are you going to go to grow in this commodity environment as a very large senior producer, mid-tier producer? And you're going to have to start picking up the developers and then building that pipeline for your growth. So we're starting to see a lot of activity in that sector too. So whether it's attention from on the M&A side or from the investors, I think we're coming into that environment over the next 6 months.
Appreciate that very much. Now, I know we are at the end of the hour, but I did want to give everybody 15 seconds to pitch something. I always like to end with that. I think it's a good way to wrap up. So, Brian, I'll throw it to you for as shameless a pitch as you're able.
Okay. I'll try to be as shameless as I can be. Gold newsletter is one of the things I do. It's goldnewsletter.com. It is the oldest investment advisory in the metals and mining sector. I believe it's the oldest investment advisory or newsletter in the world. So go to goldnewsletter.com to learn about that. The annual New Orleans Investment Conference is the longest running investment event in the world. I think everyone who's on this call will vouch for the value. And if you don't think it's worth every cent you pay to register or attend, we will refund your registration fee. That's how confident we are. Great speakers, the elite of investment intelligence. Every year, this year it's November 2nd to 5th, and you can find out about that at neworleansconference.com. And if you want our free report on the investor's guide to gold and silver, just go to either one of those websites and click on the link.
Awesome. Thank you. Rick, I'll throw it to you for a shameless pitch.
Yeah, sure. As we were talking about, if you think you've missed buying a gold bar, you should look at buying gold producers. Contango, CTGO, NYSE, New York Stock Exchange listed company, producing in Alaska. We're on schedule for producing 60,000 ounces of gold. We only have 12 million shares outstanding. So if you want, as a shareholder, leverage to gold and gold production and rising gold prices, I don't think you'll find a better leveraged company on a share basis. We're producing 60,000 ounces. We have a portfolio of assets that can get us up to 200,000 ounces of production over the next 5 years. That's our 5-year plan. So check out Contango or CTGO and the NYSE American.
Thank you. Bob, I'll throw it to you.
Okay, so Pinnacle Silver and Gold is a relatively new company. Just picked up our key project literally 2 months ago. But we're focused on a business model that deployed successfully with Great Panther Silver over a period of 13 years, where we take a past producing asset and bring it back into production very quickly and then try to grow the company out of cash flow rather than dilutive financings. And we've literally gone back into the same area of this Sierra Madre trend in Mexico, where we're only 13 kilometers away from the first mine that we acquired with Great Panther at Topia. And so we have a high-grade gold-silver asset that was in production in the 1980s, and it's our intent to try and get that back into production within the next 2 years, and then build the company from there. So it's earlier stage, but huge upsides and a lot of leverage there, and it's a chance to get in basically on the ground floor with potential producer.
Thanks, Bob. Dan, they're already gassing you up in the chat and doing a lot of the work for you, but I'll throw it to you to give any information about Highcroft that you'd like.
Yeah, and I've been multitasking and communicating with our shareholders in the chat room. And shout out to all of our apes. I love you so much, and really appreciate all your support. It's going to be a very big pivotal year for Highcroft. You know, we're culminating on the technical studies with the economics, and we're real excited to get that out. The final bit of work will be completed this summer, and then we'll start off with the mine plan. So that'll be some great news to watch, and just want to thank everybody for their support. It was a pleasure being with all of you today.
Thank you, Dan. Finally, I'll throw it to my patron to pitch the very platform that we're already on. Go for it, Daniel.
My pleasure. Thank you, everyone, for attending the event and being on the platform. We've been rolling out a lot of really exciting updates quietly in the background. We have a lot more coming this quarter. In particular, we're transitioning from being primarily about investor events to full, wholesome investor communities. This means that now you can go to each of these company pages on Six.com and continue talking away. We've launched chat forums. We've also put AI chat, so you can actually engage with different ChatGPT models and have up-to-date information about these various companies, and you can interact with them. We're adding charts and many other features. So stay tuned, and if you have any great feedback, please send me an email at daniel@six.com. Happy to take that feedback and build it into the platform.
Everyone, thank you so much. This is a great discussion. I appreciate everybody who's in the room, both speaking and in the chat, and folks who are watching on replay. Thank you all for joining us. Everybody, thank you very much. Have a great rest of your day.
Thanks everyone. Take care.